Good afternoon, everyone, and welcome to Unlock the Stock. We are pleased to welcome PBT Group back to the platform, which is specifically designed for retail investors to gain access to corporate management and to get to know their companies a little bit better. Unlock the Stock is only possible due to our technology partner, Lumi Global. Their website is lubiglobal.com, and you can visit it to learn more about the various integrated online AGM and investor presentation solutions that they offer. Our hosts today will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A session at the end of the presentation. The event is sponsored by A2X, a stock exchange playing an integral part in the progression of the South African financial markets. A2X is the second largest exchange in Africa as measured by market capitalization. At the moment, it has 169 listed securities on the platform, including 28 of the top 40 stocks. This is a combined market cap of 9.3 trillion rand. There is no cost, risk, or additional regulation for a secondary listing on A2X, and it provides and issuers investors with the opportunity to save money. The team at A2X are proud to be partnering with Unlock the Stock. Just as it unlocks value through insights and key analysis, A2X unlocks value for stocks listed on the platform, helping to drive the market forward. We would like to welcome PBT Group, which is represented today by Elisna Reed, the CEO, Bianca Peters, the CFO, and Francois de Wet, who's responsible for investment strategy and investor relations. But before we start, we have just a few housekeeping rules. We will start with a video on the PBT Group, after which we're going to hand over to management to do a short presentation, and this will be followed by a Q&A session. Please note that you'll only be able to ask questions by posting them in the chat box, which is at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel and website if you want to go and re-listen to anything. There will be an email address when we begin the Q&A session, and if you'd like to be added to the company's distribution list for notices, please send an email to this address. So without further ado, we're going to go in and watch the presentation. So Andre, are you able to share that, please?
In a world driven by data, where businesses seek to transform and thrive, PBT Group stands at the forefront of the digital revolution. With our exceptional expertise and innovative solutions, PBT Group is the go-to partner for clients and the employer of choice for data specialists and software consultants. What sets PBT Group apart is our unwavering commitment to our clients. We tackle diverse business challenges, serving clients from different industries and embracing a wide array of technologies. Whether it's consulting services, projects, or managed services, PBT Group delivers exceptional results, building long-term relationships based on trust and expertise. PBT Group's success is driven by our substantial practical data expertise and the vast diversity of our technology knowledge. On-premise and in the cloud, we pride ourselves on being a partner that aims to understand the unique challenges of each organization. We deliver flexible add-on services through the PBT Innovation function, and our cloud data migration framework enables iterative business value to ensure our clients stay ahead in their digital transformation journey. At PBT Group, our consultants are passionate practitioners who think differently and approach challenges with creativity and innovation. Working with multinational companies across different stages of digital transformation, PBT Group's consultants continuously enhance their technical toolkit, staying at the forefront of industry trends. The PBT Graduate and Cloud Academies facilitate the development of skills and our talent. What truly sets us apart is our vibrant community of technical practitioners. We believe in the power of collaboration and knowledge sharing. PBT Group provides consultants with a supportive network of colleagues who understand any challenge, fostering a sense of belonging and creating a home base for our people, no matter where they are in the world. For investors, PBT Group offers a compelling proposition. We are a focused, cash-generative JSE-listed business operating in a growing market segment, serving A-grade clients from various industries. We have a clear capital allocation strategy, and the significant ownership by management and directors ensure that interests are well aligned with shareholders. We are dedicated to maximizing shareholder value and will continue to focus on sustainable organic growth and prioritizing cash returns to shareholders. PBT Group is not just a business, but firmly believes in positive change. With a strong commitment to transformation and social responsibility, we embody diversity and inclusivity as a more than 51% Black-owned Level 1 BEE company. PBT Group believes in making a difference, not only for our clients, but also for the communities we serve. Is PBT Group your data specialist and software service provider of choice? We empower businesses to embrace digital transformation and unlock the full potential of data. PBT Group, where data defines destiny.
That was great background to PBT Group. Thank you guys very much. And now I'm going to hand over to Bianca. So if you could share the screen, please, and go ahead with the presentation, Bianca.
Good afternoon, everyone, and thank you for joining us. I'm going to start off by looking at our financial review. Financial review for the group. The group revenue grew by 12% year on year for a record 1.1 billion rand. Our EBITDA increased by 2% year on year for also a record EBITDA of 142 million rand. Our final ordinary distribution that we declared is 33 cents per share for a total distribution for the year of 58 cents per share. We paid special distributions of a total of 220 million rand per year, which is part of our strategy of disposing of our non-core assets, of which we received a total of 224 million rand, and we returned 230 million to our shareholders. The demand for our services remains strong, but the challenging economic environment can be a near-term growth hurdle. Moving over to our segments are split into three. It's our South African segment, Australia, and then Europe and UK. Our South African segment is 92% of our group revenue, which also performed very well with a 13% growth in organic revenue and an 8% increase in EBITDA, which is a growth from a very high 2022 base. Moving over to Australia, 5% of our group revenue. Unfortunately, the segment had unsatisfactory performance, resulting in a revenue decline of 15% with a negative EBITDA of 3.3 million. Although it is a small part of the group, the segment has had a significant negative impact on the group's overall results. We are focusing on reducing our non-billable individuals in the group in Australia and prioritizing breaking even and returning to profitability. Europe and UK, although also a small part of our group, satisfactory growth of 15%, and our EBITDA increased by 1%. In the current year, we had increased, in our current year, we had sales incentive fees that went through our financial statements, which affected our EBITDA. We continue to see the potential for servicing our Europe and UK segment, and with our UK and Europe segment having a higher average gross profit margins by billing in pounds and euro with our lower rand cost base. We'll also have fully fledged sales team in our Europe and UK segments, which is expected to facilitate the growth in these segments. I'm going to hand over now to Francois, which will take us through the financial highlights.
Yeah, I think it's good to just take a step back and look at how we've performed over the past 4 years, and also in the context of, a global pandemic. If we start with the revenue, top left, since 2019, we've almost doubled our revenue, and over the same time, our EBITDA has almost tripled. So that shows our ability to capture the top line growth, as well as the operational efficiency of our business. But What's also very important is the quality of earnings. And, you can see that we've consistently been able to convert our accounting earnings into cash earnings. And on the bottom left, our attributable earnings that more than tripled from 23 million in 2019 to 77 million in 2023. And over the same time period, our earnings per share quadrupled. So, lastly, what we also have is we had very good cash flows and we generate healthy cash flows, and that has allowed us to pay fairly large dividends as a percentage of our earnings. And we've consistently paid out since 2020 of about 75% of our earnings per share in the form of dividends. And then the 2023 financial year, our past financial year, we also had 210 cents of special dividends that we paid out. So I think overall, in the context of global pandemic and also the challenges, various challenges in the world, everyone faces these challenges. I think we've performed really well over the past 4 years, and now we need to focus on going ahead and performing going forward. Our 5-year total shareholder return is measured as the increase in the market cap plus our cash returns to shareholders. So in 2018, we had a market cap of 250 million, which increased by 689 million. And then we also paid out, returned 400 million in cash to shareholders for a total shareholder return of 40% per annum over the past 5 years, which we are very happy about. But also what this chart also shows is that we prioritize cash returns to shareholders.
Martin, good afternoon, everyone.
Yes.
Thank you very much for having us. Just a bit back to the basics of who we are. PBT Group is a very uncomplicated group structure. Directly underneath the listed entity is PBT Group International, incorporated in the Netherlands. This company holds the various international as well as South African operating entities, including PBT SA, PBT Europe, PBT UK, and PBT Australia. The international holding entity provides us with corporate flexibility and we believe supports our further expansion in the EU and UK markets. During the 2023 financial year, we successfully disposed of all of our non-core assets and returned the proceeds to our shareholders. Our focus is thus now fully on our core professional services. PBT's service offering is divided into data and analytics, software development, as well as insurance technology services. Our data and analytics service offering includes all aspects of the modern data platform, such as advisory and strategic, data architecture, data modeling, data engineering, analytics and visualization, data migration, and all of this being done both on-premise and in the cloud. Our software development services span the full software development lifecycle, including application and software development, cloud and DevOps, software and software quality assurance and testing, mobile and web development, user interface, and user experience. Again, 92% of our revenue is derived from South Africa, 5% from Australia, and 3% from Europe and the United Kingdom. We are proud of our well-established relationships with our A-grade clients, which spans over a variety of industries, such as financial, insurance, telco, and retail. Our management and employee shareholding of 53% confirms that our interest is well aligned with that of our shareholders.
The next section, I look at Bianca, if you can just go one back, please.
Yes.
The next section is just on our segments, our revenue, our costs, our operating leverage, our capex, and our free cash flow. On our segmental slide on the left, 92%, almost all of our revenues earned in South Africa. And the chart on the right, Bianca did touch on this earlier, but our South African segment did well as our European and UK segment. But unfortunately, our Australian segment was a big drag on our group's overall performance. But as Bianca said, we have put measures in place to fix that. But as a whole, South African segment, 92% of group revenue performed really well. So our core South African business is still performing well. We typically engage with our clients in three ways: consulting services, projects, and managed services and solutions. But consulting services, that's the bulk of our engagement with client. Our client industries, we serve various clients and our clients in various industries, but 3/4 of our clients operate in the financial services space. So that's your banks, insurers, your wealth managers, your asset managers, and the rest, the other quarter is in a variety of industries. But what's important is that our consultants are interchangeable between these industries, so that reduces our risk of having non-billability. Our top 10 clients make up 61% of our group revenue, and these are large, mostly JSE listed businesses. And although we list a client every year as a single client, we service various and distinct business units within these clients, which provide diversification for us. On our client retention of our top 10 clients, we retained all of our top 10 clients, and we actually grew as well within each of our top 10 clients, except for one. But on average, we earned 18% more revenue this year from our top 10 clients versus last year. And I want to, before we go into the next slide, I just want you to take this slide and the next slide. You must use that in conjunction with each other. So 98% of our contracts are time and material based contracts. And our contracts typically span over 12 months, and after which they are typically renewed. So taking this slide with the previous slide that I showed, the fact that we retain all of our top 10 clients just shows the stickiness of our client base. Our cost breakdown in 2023, for the 2023 financial year, we spent 11% of our revenue was spent on operating costs, and this is mainly on salaries relating to sales, general and administrative employees. And we do not expect to add materially to this headcount in the foreseeable future. And on our cost of consulting, 76% of our revenue, this is basically, this is our business. This is split between salaried consultants and contracted consultants. So the salaried consultants, where there's risk of non-billability, but we earn higher gross margins from our salaried consultants. And then on the contracted consultants, we have lower risk of non-billability, but we also earn a lower gross profit margin. But with the both of them combined, I think it gives fairly nice diversification for us. Our EBITDA margin, it expanded very nicely from 2019 to 2022, but unfortunately in our 2023 financial year, our EBITDA margin contracted, and this was because of general inflationary cost pressures, our Australian segment being a drag on our profitability, and we also had some non-billability at the beginning of the year, towards the end of the 2023 financial year. We have a very asset-light business, meaning that we do not have to spend a lot of money on maintaining or growing do not spend a lot of capital on growing or maintaining our business. And you would see that in the 2023 financial year, there was a slight uptick in our CapEx spend, and this was because we bought a new server, and this server is expected to last for about 8 years. But in context, it's our CapEx as a percentage of group revenue is still below 30 basis points. So I think still below 30 basis points of group revenue. So I think fairly immaterial in terms of our CapEx spend. And because of our really good clients that we have, our A-grade clients that we have that pay on time, and because we are such an asset-light business, our cash earnings consistently track our accounting earnings. And this has allowed us to allocate a large portion of our after-tax earnings to pay as dividends.
Okay, back to me. I'm just going to have a quick look at the summarized financial statements. Looking at our statement of financial position, you'll see the investments at fair value for the current year is 0. That is due to the investment in pay apps having been sold on the 31st of March this year. So obviously not there anymore. Our trade receivables, the increase in our trade receivables is combined with our increase of revenue, so it is expected to go up a little bit. So it's in line. Our cash and cash equivalents, the big balance sitting in there is due to the sale of investments in pay apps, the cash having been flowed on the 31st of March. And due to the cash we paid out a distribution just after year end, declared in April and then paid in May. Trade and other payables up slightly. I'm just going to move then to our statement of comprehensive income. As mentioned twice before, the South African segment is 92% of our group revenue and primarily drove the group's robust organic revenue growth. Our profit margin contraction is primarily due to inflation pressure on costs and the Australian segment being a drag on our profitability, which is 3% of our group revenue. Moving on to statement of cash flows. We continue to generate strong cash flows and we prioritize organic growth and returning cash flows to shareholders. Let's now over to you.
Okay, so we have a clear capital allocation strategy. We will continue to expand organically. This is a focus area. This includes securing new clients as well as continuing to grow our footprint within existing clients. A substantial portion of our earnings is paid as distributions. We have a share repurchase policy which directly benefits our shareholders, and we will continue to consider strategic acquisitions, but this is not currently a focus area. Over the past 5 years, we returned 400 million to shareholders through a combination of distributions, share repurchase, and increased shareholding in a subsidiary company. To put this into perspective, at the start of 2019, our total market cap was only 250 million rand. So why should you invest in PBT Group if you don't already do that? We are a focused business. We operate in a growing industry. Our business is cash generative. We service A-grade clients. We have a clear capital allocation strategy as well as a clear value unlock strategy. And our management and employee ownership aligns our interest with that of our shareholders. Thank you very much.
Thank you so much to everyone who presented. It's now time to do the Q&A, so I'm going to hand over to Mark Tobin and the Finance Ghost. And just as a reminder, you can pop your questions into the chat box at the bottom of your screen. So Mark and the Finance Ghost, over to you.
Thank you, Vanessa. Thanks to the team at PBT and welcome everyone to this edition of Unlock the Stock. PBT Group's very interesting little business, as you've seen. I must commend you guys on the level of disclosure. I read, I think, every SENS announcement on the JSE, and the PBT stuff is always easy to understand. And you've used a lot of the wording there, you know, uncomplicated, simple. It's true. So thank you for that. Genuinely, it's quite rare on the JSE. I think first question, and also just something worth highlighting. And I think we've talked about this before on Unlock the Stock, but I think it still applies. And that's, you know, those who buy the shares through Easy Equities will not necessarily pay any brokerage. You've got to deal with Easy Equities there. And that initiative, I think, is the first of its kind. I think just worth touching on that, Francois, maybe you're the right person for that, I'm not sure. Just how that works, why you've done it, and how long it runs for.
Yes, thanks, guys. This was an initiative that we put in last year, and we extended it now for another year until 2024. And basically, it's, as you mentioned, anyone that wants to trade, buy and sell PBT shares on the Easy Equities platform, we will reimburse their commission that they paid to Easy Equities. So I think it's just a nice way of making it easier for people to trade in companies, and just being part of the whole process of democratizing investing. So yes, that's in essence what it is. Program runs for another 12 months till June 2024.
Yeah, I'll just echo the Ghost's comments. Thanks for coming back and giving us an update. I also just want to mention I am a PBT shareholder, so in the interest of disclosure for everyone on the call. Maybe just a question from me. Obviously, there's been a lot of distributions this year with the sale of the non-core assets. Can we just talk about, you did touch on it in the presentation, I think in France, one of Francois' slides about, the dividend policy normally should be 75% or thereabouts of NPAT. Is that still going to be the case moving forward, or is there going to be a slight change now after all of these big distributions from the sale of the non-core assets?
No, I think our capital allocation strategy is quite clear in the sense that we really prioritize paying out a large portion of our earnings as dividends, and that should continue going forward. We are a cash generative business. We aren't looking at making big acquisitions. So I think investors should expect for us to pay a large portion of our earnings as dividends. And it has been about 75% there or thereabout of our normalized headline earnings per share that we pay out as dividends.
I'll jump in with the next one. So it's one in my DMs from one of the attendees already. So good to see the questions coming through. I also wanted to ask you about Australia, and this is more of an international question. The thing with the Aussies is we do a great job of blitzing them at rugby, and they do a great job of blitzing us quite often in business. It seems to be a relationship of South Africa and Australia, and it's obviously an area where you've struggled in the latest results as well. So my question was, what can be done in Australia realistically to kind of turn that around? And the question I got in my DMs was linked to that. What plans have you got to grow your revenue outside of South Africa? So just talking to the kind of international strategy, I think, of PBT.
I'll answer that question. In Australia specifically, our focus is on returning to profitability first. We experienced some specific setbacks during the past financial year, such as the loss of billable positions at a prominent client, along with pressure on margins, where we are often forced to engage with clients through brokers. This coincided with the redeployment of one of our data specialists from South Africa to Australia, with a view of growing our data and analytics competency in the segment, which previously largely focused on software development. The timing, depending on how you look at it, was either bad, considering added non-billability at the time, or good, as the foundation has now been laid for future growth and a positive turnaround for the Australian business. In terms of international beyond Australia, the EU and UK business is still doing really well. We do have a lot of hope for that business to continue growing. And as I think we already mentioned in our presentation, we have the benefit there of providing services remotely from South Africa at SA-based consultant rates, with obviously then bigger margins from those European countries, or euro and pound rates. So there is still a lot of emphasis on growing EU and UK specifically.
I think, guys, I must also add, we've been in Australia since 2005, and we've actually done really well in Australia, and also the whole pay apps investment came from our business in Australia. So I do think that since 2005, we've actually done really well for shareholders in Australia. But I agree, this year, that the past year, the 2023 financial year, it does look like they did beat us.
So Springbok level performance overall, just for the recent.
Yes, it's just the last one. Yeah, the last year.
Just one that's come through on my DMs. Just where are you seeing the growth in the consulting business? I don't know if they mean internationally now or the SA business. Is it coming from that data analytics side? Is it coming from moving legacy platforms into the Microsoft Azure cloud-based system? Like, which part of the consulting offering is really driving that growth? As Francois, you touched on, you've now retained all your clients and got more business from them. So like, where is that new business coming from in let's call it a spade, a very, very tough South African economy, which is the vast majority of the revenue base?
I think firstly, we've got the two areas in the business that complement each other very well. We've got the traditional, from what PBT started, the data and analytics side of the business. And then we have the software development side of the business. And it has been a case of where the one perhaps doesn't do as well in any given year, the other one makes up for it. On the data and analytics side specifically, there is a lot of focus from clients on migrating to the cloud, and that is something that the software development side, in the digital world that we live in, obviously there is a continued need from clients to expand on what they have to offer in terms of the digital offering for the service that they provide to their clients. So yeah, it's complementary between both data analytics and software development.
I got a question in my DMs around artificial intelligence. I knew that was coming. So the question is, how big a risk is it for disrupting a data analysis business? I would be surprised if it's not an opportunity for you guys. Well, let me not answer the question for you. How does AI impact PBT Group?
That is perhaps a tough one, considering that we don't have any of our technical expertise here to assist in answering. We have obviously looked at it a bit and asked the question internally as well. At this point in time, not a threat at all. I think where our strength lies in the back end of working with the data. We do not foresee that AI will at any point in time take over or provide the services that PBT does. Opportunity, perhaps, yes. At this point in time, it's not something we're looking at getting involved in, but the business expands. So we will have to wait and see, I guess, like many others.
Just another one in our DMs around being a BE level 1 company. It's set up quite nicely to engage with the public sector in South Africa. But the public sector isn't one of your kind of top 10 clients. Is there scope to start doing stuff with government, whether that's at a national level, provincial level? I don't think you'd be moving down into municipal level, but is that something you're thinking in that organic growth strategy that you talk about? Is that somewhere a sector of the market you want to try and get involved in, or are you happy to stick on the private side?
It's definitely not a focus area, and not it being government specific, but just being that we service a variety of industries already, and we know where our focus is definitely on the financial side. It's where we have our strongest, best clients, and we are possibly fairly thinly spread already. So we would rather focus on where we know that there is a demand, and we manage to services, and we're doing well. And a lot of other opportunities still with some of the smaller clients that we service. So again, never shying away from new business, but at this point, not a focus area.
I have a question in my DMs again about just the inflationary pressure on costs and how much of this can kind of get passed on to clients on renewals of contracts, or how much of it gets absorbed to retain clients. And then something I want to add on to that question, when I researched Accenture, sure, it was a few months ago in Magic Markets, but a big part of what they are doing is obviously just offering more and more skilled services to try and ramp up their sort of rate per hour, get the billable rate up, because obviously when you're selling time is the only truly finite resource in this world. So I guess it's a two-part question. One is, can you comment a little bit more on, to what extent inflationary pressures on costs can at least be passed through to customers, at least going forward? And then two, to what extent do you think there's an opportunity to actually get the billable rate higher, or do you think it's likely to kind of stay where it is with inflation? So I guess a pricing question.
Okay, so yeah, we've certainly been experiencing pressure on our profit margins for various reasons. There's pressure from consultants whose skills are on high demand to earn more. This we will continue to manage through reassignments between different roles or different clients, recruiting top graduates and providing them with fast-track training, and to a degree adjusting client rates as consultants move through the ranks. I might be repeating some of what we've already said, but we did have specific scenarios during the 2023 financial year that put pressure on our margins. Australia obviously being one of them, where one of our major clients ended a number of consultant engagements as they move towards insourcing or permanent appointments. The Australian business is relatively small and already under pressure, often forced to work through labor brokers where markups are predetermined. So this was definitely a setback. In Australia, as I know you would have read in our integrated report as well, our letter to stakeholders, we had 2 large-scale projects that were cancelled close to the end of the financial year. We managed to successfully redeploy the affected consultants, but not before experiencing some non-billability. These redeployments, of course, also meant that internal staff were used for new opportunities rather than bringing in additional staff, which further placed a hindrance on our growth during the past financial year. So for Australia, again, there is a plan of action in place, and with the South African bench consultants already having been redeployed, and the focus being on attracting new consultants for a long list of existing client requirements, we're already experiencing a positive effect on both our profitability and also revenue growth. In terms of your question around Accenture and looking at not just increasing billable hours, but rate in terms of the type of skill sets that we offer, we have a wide range of skills offered, and obviously that goes along with different levels on which our different consultants operate, and that determines their rates. While the long-term engagements that we have with our clients minimize our risks, it unfortunately also minimizes opportunities for beyond inflation increases. There is opportunity for high margins where our principal consultants provide advisory skills services to clients, but this is limited to a small number of consultants. The biggest opportunity remains providing services to clients in Europe and the United Kingdom, remotely from South Africa, again, where profit margins are considerably high.
Just another one. You mentioned the alignment with I guess the retail or non-management shareholders. We've got a question on who are the kind of major shareholders within PBT Group. Maybe might be one from France, or just who are some of the bigger players, and is it some of these BE funds that are or partners that are giving you that level 1, or how is it being achieved?
Yeah, so we did put it in our slides. It's mainly management and directors of subsidiaries within the company, and then management at the top level. And then we also have a big investor, the Intrepid. They're also a big investor in us. Otiel, the Intrepid, they also invested in us. They invested in us in 2021, That was a transaction that we did then, and yeah, so we're over 51% Black-owned company, and that is something that we're happy about and looking to keep that way.
Perfect.
Maybe a bit of a more detailed technical question, but just something I found interesting when I read your latest results. So I know PBT Group's always been quite technology agnostic. In the UK, a little bit more of a focus on Azure. I'm also a Microsoft shareholder, so I found that interesting. So I guess just any comments you might have around that. That seems like quite a strategic shift, or does it sound like more of a shift than it really is?
Yeah, probably sounds more like one than it actually is. The focus on Azure in the UK is purely driven by demand, and our offering remains technology agnostic, both locally and internationally. But it does create opportunity for knowledge sharing back to South Africa, where we experience a higher demand for AWS services at this point in time.
Just in terms of the non-core assets have now been disposed, it's fully focused now on, the PBT Group, growing organically. As you said, acquisitions are not really on your radar, although I'm sure you wouldn't turn down a good one if it came across your desk. But if we look at, say, like 3 to 5 years from now, the split between South Africa and international in terms of a revenue base, is there now a kind of a goal or something you're trying to achieve, like 75-25, or is it just going to naturally evolve where clients are upgrading, new clients are being signed into various markets? Is it that kind of way, or are you really trying to, we want to have a certain, or try to have a certain amount of our revenue coming from offshore that we can easily service, especially in the UK and the Europe business, we can even easily service from South Africa given the limited time zone differences?
I'll quickly talk to that one. We don't have a specific split. We are actively trying to expand our international segment, specifically in the UK and Europe. We also don't have a target split that we want to achieve regarding SA versus international. Because the international segment is small relative to SA, it is easier to grow from its smaller base, and naturally the international segment should become a bigger portion of the group revenue as time passes. It is, however, important to remember that because of its small base, the UK and European segment will most likely take a long time to become a significant contributor to the group's revenue.
Okay.
I've had some questions in my DMs around M&A ideas, some budding corporate financiers who think that you and some other companies might belong together. And I can't ask you to comment on specifics because it's not a fair question, because you just can't comment on it publicly. So I'll make it broader than that, which is to ask whether, is the growth path for you here organic in nature? Does it maybe have some bolt-on acquisitions in it? Are you sending Francois out there to do some huge transactions? Obviously, there's only so much you can really say publicly, but I think people will be keen to know how you think about this. Are you an organic or an inorganic growth path, or a bit of both?
I think I can answer that one. I think, again, we want to be very clear that we are looking to grow organically. We don't really look at acquisitions. We're going to grow organically. We're going to pay out our earnings as dividends. We might buy back some shares if in our view the share price is cheap relative to the value of PBT. And I think it must be very, very clear. That's the idea. Organic growth, paying large dividends, some share buybacks, acquisitions not really on our radar. And that's I think if it's perhaps also a bigger question. It's a bigger question, and it can be a bigger discussion, but I think we really focus on building a quality business. And if you do all these acquisitions and you have to integrate these businesses into the company, and it can take a lot of your focus away from your core business of growing your business organically. And what we've also seen, I showed in my previous slides, over the past 4 years, we've, throughout the pandemic, I think we increased our revenue 17% per year over the past 4 years. So it's not that we need to do bolt-on acquisitions or big acquisitions in order to grow. We are able to grow organically, and because we are such a asset-light business, it doesn't cost us a lot of money to grow at quite a nice rate. So for us, that's the strategy. Grow organically, pay dividends. That's it. It's quite straightforward.
If we can just maybe delve into that a little bit more, Franz, in terms of growing organically. I mean, given the size of the customers that you generally deal with, these are enterprise kind of level clients, and I'm assuming the sales cycle to, from initial conversation to actually, the first invoice of billable work done is quite a long one. How do you guys go about actually getting in front of, CTOs, maybe even CEOs of these businesses, to present a case for doing work for them? Is it, one CTO moves from one institution to another, has worked with you in the past, wants then to get you in there, or are you actually banging, knocking on doors saying, we've done this for, I'm good to two random examples. We've done this for Capitec. Look, we can do something for you guys over here at All Mutual, and, pitching projects to them.
I think, listener, that might be for you.
Yeah, sure. I'll actually answer that. We have a very strong sales team who ensure that we consistently grow within existing clients, also across the various departments within their businesses. And yes, they do have connections at the right levels, and obviously from that stems word of mouth. We place a very large emphasis across all of our business on networking, and be it a CIO that moves from one business to another, or a consultant who joins another business in a senior position, or whatever that the case may be. A lot of our sales do stem from that, because obviously if you have a strong brand like we believe we do, your reputation precedes you in a good way, and that does open up doors through a combination of that positive feedback and the strong sales team that we work with.
Have you got BDMs then on the ground in every market? So there's somebody looking after Australia clients, South Africa, Netherlands, UK.
Across all the business segments, we do have BDM teams on the ground at clients. COVID changed that view a little bit, unfortunately. At some point, I think some of our BDMs actually had desks at some of the clients where they would be able to come and go and spend their day there. So we very much believe in being in their face, being there to assist with whatever, whenever, and making sure that our teams do the best possible job, and being able to identify new opportunities and service those.
Well, quite a detailed question in my DMs here. If you ever wondered if investors are reading note 553,000 of the integrated annual report, yes, they are. So the question is around the finance. Yeah, I know. But I mean, it should be okay. So I think the question is around the finance costs on borrowings. And obviously at year end, the borrowings balance wasn't there. But during the year, there was the 30 million in notes to South Chester investment managers. I imagine that's the reason why the borrowing cost went up year on year, the finance cost on borrowings. I think just 2 minutes on what that was. Basically, there was 30 million in notes issued to South Chester investment managers in May 2022, and then it was gone by March 2023.
Yeah.
Rech,
I can take that one. What it was at that point we had non-core assets. So we've got two splits of non-core assets. We had the investment in pay apps, and then we also had where PBT had used some of its cash resources to, let's call it, lend. It was through preference share investment, but we say we lent that money to a BEE and staff vehicle, and they used that money to purchase PBT shares. So that was a non-core asset of ours. Those non-core assets were at that point, I think, valued at about 60 million, those non-core assets. And then what we did was we essentially borrowed money from South Chester, the 30 million, that we had against the 60 million of non-core assets. We paid that out, and then as a special dividend, 30-cent special dividend. And then what we did was, when we sold those non-core assets, the money that we had lent to those BEE and staff vehicles, when we sold that, I think it was November last year, then we were able to distribute the rest of the assets. So it was, we essentially synthetically sold some of the non-core assets in the beginning part of the year, and then when we eventually did sell those non-core assets to a third party, we paid out the rest of it. So at the moment, everything is 100% clean. We sold 60 million, or we paid out 60 cents of special dividends from those non-core assets, and then from our pay-ups investment, that part of the non-core assets, we paid out the 150 cents in special dividends. And what we're left with now is no non-core assets at all, and just focused on our core business.
Question in my DMs, this might be for Bianca maybe, going back to the average 18% increase in revenue generated from those top 10 clients. Just if somebody wants a breakout of how much is that is just a standard price increase versus actually new work done, and a new volume. I guess the kind of breakdown between price versus volume in terms of that 18% increase.
Sorry, you broke up a little bit, Skis.
Sorry, I was saying, no, the question is around the average 18% increase that the revenue went up with their kind of top 10 clients. It was one of Francois's slides. Somebody's asking, why is the kind of breakdown of that between just a pure price increase, which is obviously going to push up your revenue, versus, actually doing more work for them. So a kind of a price versus volume split on that kind of general increase that you've seen with the top 10 clients, if that makes sense.
Yeah, we don't have. Sorry, Bianca, go ahead.
Yeah.
No, we don't have a specific split for that. I don't have that specific split for you. But what I can tell you is that there was a lot of volume. I think most of it came from volume increases within the clients that we had.
Okay. Yeah, I mean, if we even take 6-7% in inflationary increase off that 18, I mean, that tells you 10-20% increase in volumes, just if you assume a standard inflation increase.
Yeah, now there is a portion of obviously of pricing increases, but the bulk of it came from volume.
Okay, perfect.
I've still got a couple of questions in mind to get through, Mark. I'm not sure how your DMs are looking, but let me jump through. So one of them should be relatively quick, which is what are your current plans, or what's your thinking around share buybacks on the PBT share price? That's the one.
I can answer that. I don't think we're not actively buying at the moment. We at the moment we're using a bit of our excess cash to pay out as dividends at this point. It's not something we're actively doing at the moment.
And then Mark, if I can ask the one other one in my DMs that I think is a slightly bigger question, is just a couple of minutes commenting just on, who some of your big competitors are in this space, just to help people understand, who are you really up against out there? So the one reference that came up in my DMs was something like Synthesis within Capital Appreciation. I'm not sure if you'd see them as a major competitor. Maybe just a couple of comments around that.
Listener?
Yeah, no, it's probably quite widespread. I'm trying to think. I think we had the same question last year, actually, which is not a bad thing. But the reason I'm thinking about that is that we're in the unique position that maybe not answering the question to the full extent, but we're in the unique position where within the PBT group of companies, we have businesses that both complement each other in terms of the skills offering, as mentioned before, data analytics and software development, but also are friendly, so to speak, competitors to each other. So again, a very unique position to be in, where we both service the same clients. Sometimes one of us has a client that the other one doesn't have, and then there's a bit of again, friendly competition. But in the bigger group, that is obviously a fantastic opportunity to not lose to a competitor outside of that business. And we have a couple of clients. There's a big drive at the moment from clients for full-term or permanent employees versus outsourcing. We've seen that over the years where it's got it comes and it goes. It's happened a few times. They're definitely on a drive at the moment. And we have a specific, one of our big clients where only the companies are PTS, the PBT Technology Services, Data Analytics side, and CyberPro, the software development side, where they're only two service providers that are currently on the preferred supplier list providing outsourced services. So again, a very unique and fortunate position, I think, to be in.
I think, guys, if I can also add to that, from a listed point of view, we are the only listed company that does what we do. I think if the investors or anyone on the call want to get a read through from some of the other listed companies, I think you have to look at some of the subsidiaries of some of the other listed companies. So, for example, Capital Appreciation, they've got Synthesis. I think that is and they also recently bought Dariel Solutions. I think it's Dariel Software. Those would be the most direct competitors in the listed space if you want to get a read through. So they're subsidiaries of Capital Appreciation. Yeah.
Gus, I don't have any more. We are like a minute or two away from the top of the hour. Well, I don't think we can squeeze in another question, even if you have one.
My DMs look pretty much done and dusted. I'm just looking through the list as well. I think we've touched on all the key points. I think we could probably leave it there, Mark.
Oh, great. Thank you very much.
Thank you very much.
Thanks to everyone who listened in and participated in the questions today. And then a special thank you to Elisna, Bianca, and Francois for making the time to support this again and to engage with retail investors. We all appreciate it very much. To the retail investors, we hope you've enjoyed this. And if you'd like to listen to it again, just a reminder, it's on our Unlock the Stock YouTube channel. And we do encourage you to subscribe because as soon as it is up, you'll get a note. And then just to remind you that we will be back this time next week on the 20th of July for a session with both companies who are repeat clients of Unlock the Stock, Capital Appreciation, and the Spear REIT. So please look out for those invitations. Thank you, everyone, and goodbye.
Thank you very much, everyone.
Thank you very much. Bye.
Thanks.